Hello everyone, welcome back to IFRS is Easy. Today we'll be continuing our journey into the world of derivatives. And if you have not watched the first video, please go into the description box and watch, because what we'll be explaining today will be based on what we explained previously. So we'll be looking at classification and measurement. We have looked at understanding financial instruments, and now we want to say, how do we classify those financial instruments that we previously understood? Now, the classification and measurement is very important because it's part of our journey into understanding what derivatives are. And so today we'll be looking at how those financial assets, financial liabilities, equity that we have identified in the previous class, how we are supposed to classify and measure them with respect to the requirements of IFRS 9. So let's get started. So we mentioned in the previous class that financial instruments are broken down into three. We have financial assets, we have financial liabilities, and we have equity. And if you remember this picture very well, this was what we used in explaining what derivatives are, when we mentioned that the oranges are the normal transactions, while the juice is the extraction from those transactions that gave rise to the derivatives that we have. Now, we mentioned that financial assets are categorized into two. We have the derivatives and we have the non-derivatives. The non-derivatives are the normal financial assets, while the derivatives are the extraction from the normal financial assets. And so for the non-derivatives, we mentioned that they are split into two. We have those that represent the investment in equity, which is a financial asset, and then others are debt instruments. And so it means then that our financial assets are broken down into three. The first one is the one that has to do with non-derivatives, which is either investment in equity or debt instruments. And then the third one is the derivatives themselves. For financial liabilities, we talked about the fact that they are also split into derivatives and non-derivatives, but financial liabilities only have debt instruments as non-derivatives. We do not have investment in equity because, investment in equity is actually a financial asset. Equity are always non-derivatives. Okay, so how do we classify and measure? The way we classify is the way we measure. So if you classify something as amortized cost, you measure it at amortized cost. If you classify it as fair value, you measure it at fair value. So that leads us to what the classification categories are. We have two basically. We have the amortized cost and we have the fair value. The fair value is now split into two. We have the fair value that is carried through profit or loss, and we have the fair value that is carried through other comprehensive income. Now, amortized cost is basically tracking of the inflows and outflows that has to do with cash flows. The amortized cost talks about the outstanding balance you have, the interest that has accumulated on those outstanding balances, and the payments that has reduced those outstanding balances. That's what amortized cost does. So it tracks our cash flows. So amortized cost shows you how the cash flows will look like. But our fair value will not show you how the cash flow will look like, because our fair value is only useful at the point of sale. So it's just the way we treat disposal on PPE, and at the point of sale, we say what is the gain that has been made as a result of this sale of PPE. That's what fair value does. Fair value tracks the gain or loss that you make if you are to sell that financial asset that you currently have as at today. That's what fair value does. But amortized cost tracks the cash flows and inflows and outflows. But fair value says how much will you make if you are to sell this particular financial asset today. That's what fair value does. So basically, your fair value makes decisions based on the asset's fair values, and it manages the asset to realize those fair values. So you are saying that if you want to realize the fair value on this particular asset today, how much gain or profit will you make? And so the split into either fair value through profit or loss or fair value through OCI is saying that if I'm to sell this financial asset that I currently have today, how much will I take to profit or loss? The other one that has to do with OCI says if I'm to sell my financial asset today, how much will I take to OCI? So basically, fair value focuses on the fair value information of the asset, while amortized cost focuses on the cash flows of the financial asset. So it is important that we're able to identify the difference. Amortized cost talks about the cash flows, while fair value talks about the profit or loss that you will make as a result of disposing that financial asset. Now, this is important because we mentioned that the way we classify is the way we measure. Our classification and measurement are based on these two principles. The amortized cost is focused on the cash flows, while fair value is focused on the gain or loss that arises as a result of disposal of our financial assets. So we have established that the way we classify a financial instrument is either through amortized cost or through fair value. Now, if you look at this schedule, I explained this under the video for staff loan, where I did amortization on staff loan that was released to a staff. So if you want to check how the cash flow works, there's also an Excel file that was attached to the video. So just look at the description box below. You will see you will gain access to the video so that you can watch it and understand better how amortized cost works. But basically, amortized cost tracks inflows and outflows of cash, and the balance that you have at the end of the year is what you record. But fair value does not do that. Fair value just says what is the current realizable amount as a result of this financial assets, and that's what we recognize. Any difference between the opening balance and the closing balance goes to your profit or loss, or goes to your OCI, depending on which of those two split of fair value you have chosen as a result of your measurement criteria. Okay, so we have established the fact that our financial assets are split into three, although into two, but into three, because we have said our non-derivative is split into two, which is debt instrument and investment in equity. And I've also said that we also have derivatives, which leads us to three aspects of our financial assets. We have the debt instrument itself, we have the investment in equity, and we have the derivatives. If you look at this decision tree, it is a simplification of what you are supposed to do in order to classify and measure your financial assets. You see that it starts with debt, and then it moves to derivatives, and then it moves to equity. The equity that you see here means our investment in equity. Just the way we have it, where we said we have debt instruments, we have investment in equity, and we have derivatives under our financial assets. So it's showing us the decision tree on what you are expected to do in order to be able to arrive at a conclusion of whether to carry it at amortized cost or to carry it at fair value, either fair value through profit or loss or fair value through OCI. But we won't be looking at this yet so that you don't get confused. We'll be looking at how we are to make our own decisions based on each of the financial assets that we have identified. And by the time we are through with explaining, by the time you come back to this table, it will be very, very easy to understand. It will be clear and simple. Okay, so let's start with the one in the middle. That's the derivatives. We'll move from derivatives to equity and then to debt. And there is a reason for that. For simplification purpose, we have to do that because we have a whole lot of things to explain on that debt instrument. So let's take it from derivatives and then we'll move to the investment in equity. The equity that you see here, remember, it is investment in equity because that is what represents our financial assets. So let's start with derivatives. If you remember, we mentioned that derivatives have three characteristics. The first one is that its value changes in response to a change in a variable that is not specific to the underlying item. The second thing is it requires no initial investment, and the third thing is that it is settled at a future date. There are two major reasons for holding a derivative. The first reason is either because you want to guide against risk, and the second reason is either because you are trying to speculate so as to make profits on your financial assets. Now, it is important to know this difference because that is what determines how we classify and measure. In fact, that is what determines how our derivatives are measured. And so the first thing is, are you hedging against a risk? Are you trying to protect the fair value of the asset or protect your cash flows? That's you hedging. You are hedging a risk. That is, you are trying to be cautious of an event that might cause losses to you. But the second one is that you are trying to make profit from an uncertain event, which is speculating. So it is either you are hedging or you are speculating. If you look at what we have here, we have some of the products of a crop farmer. So this crop farmer fears that the price of his products, his farm products, might fall in the nearest future. And so he enters into a forward agreement to say, I want to lock in this price so that if the price falls, I'm still able to sell to you at this particular amount. And so he enters that agreement in order to hedge the risk that prices will fall. So in this case, what he's doing is hedging. Now let's look at another example where you actually have some dollars in your account. So you are looking at profiting from it at an exchange difference that is favorable to you in the future. Now, what you are doing is you are speculating that you will have a favorable exchange difference in the future. Now, if you have entered into a contract with your bank in order to speculate for that profit, then what you have is you are speculating, you are not hedging. So hedging has to do with fear that you may make losses, while speculating has to do with you wanting to make profit out of a particular situation. Now, the difference between the two is what drives how we classify and measure derivatives. Now, because we can't know what's driving the derivatives that the company has, that is the reason why the IASB have made hedge accounting not mandatory, because it is entity specific, and as a result, companies are only able to say this is the reason why we have entered into this derivative transaction. We are trying to hedge against a particular risk, or we are trying to profit from a particular event. It is the company that will be able to determine or decide or explain in their policy that this is what we have chosen, and this is the reason why we are entering into this transaction. You can't really know, and that's why hedge accounting is not mandatory. And as a result, there are even criteria that are expected to be met, such as hedge effectiveness and so on, before you can say you want to classify under hedge accounting, as you want to classify your derivatives under hedge accounting. So that leads us to how we classify and measure our derivatives. So the question we'll be asking is that this derivative that you're holding, are you holding it to hedge against a risk? The question is it held for hedging or not? If your answer is no, then IFRS 9 says just measure it as fair value through profit or loss. But if it is held for hedging, then we use what we call the hedge accounting, as long as it meets the criteria for hedge accounting. So it is important that we ask this question before we classify and measure derivatives. So normally, if you're measuring derivatives, you measure them as fair value through profit or loss, because derivatives are tied to market changes. So automatically, what they are looking at is they are looking at how to realize whatever transaction they have entered, and what drives it is fair value, which is market value. As a result of that, what can explain our changes in our derivatives is the fair value measurement, not amortized cost, because we're not looking at cash flows, we are looking at what we can realize as a result of entering into this transaction. And that's why derivatives are always measured at fair value. If it is held for hedging, we use hedge accounting, which is something that we have to discuss in a whole class itself. Now let's move to the equity, which is the investment in equity that we are talking about. For investment in equity, you will still remember this picture where we talked about investing in the shares of a shipping company. Now, if you're investing in shares with the purpose of selling those shares, say you've invested in this shipping company, or you've invested in the shares of Microsoft or any other company, and your purpose of holding the shares is to just make short-term gains, that is, sell it off and buy another shares, meaning that you are holding those investments for trading. IFRS 9 says you should measure it, you should classify and measure it at fair value through profit or loss, because what you are doing is you are making gains or losses as a result of transacting in those shares. So majorly when you are holding an investment in equity for trading, what you are saying is that you are trying to make gains by selling the shares at a share price that is higher than what you bought it, meaning you are trying to make short-term gains. Now, there are times when you make an investment in equity, but your plan is not even to sell those shares. You just want it to keep gaining capital value for a long period of time. Now, for example, imagine that McDonald's actually invests in one of its suppliers that supplies its eggs. Now, because the transaction is supposed to last for years, for years not determined, and because McDonald's does not have any plan of actually recovering the investment that it has made in the poultry farm, because the investment is driven by the fact that it wants to keep that company afloat, and because it wants to have some shares in that company that is transacting with. Now, because the gain is not expected to be realized in any short-term period, we don't take the fair value changes to profit or loss. We take those fair value changes to other comprehensive income. And even if McDonald's now chooses to eventually sell those shares in the later future, the IFRS 9 says we do not recycle. What that means is that at the time of selling those shares, you don't take that gain to profit or loss. You retain it at other comprehensive income, that is as part of your reserve. So that leads us to the question of, are you holding this investment in equity for trading or not? If you are holding it for trading for the purpose of making short-term gains or losses, what do? You measure it at fair value through profit or loss. But if you are holding it for a period that is not near term, that is in the future, and you do not intend to sell it at any point in time, then you measure it at fair value through OCI, because there's no point tracking changes in profit or loss when you are not actually going to realize it in the short term. And so what you do is you measure it at fair value through OCI, and you do not recycle, that is, you do not bring it back to profit or loss at the point of disposal. So now let's talk about debt instruments. We have talked about the equity, we have talked about derivatives. We said derivatives could either be hedging or speculating. If it is hedging, we use hedge accounting requirements. If it is not hedging, that is, if it is speculative, we use fair value through profit or loss. Now for investment in equity, we say that if it is held for trading, we use fair value through profit or loss. If it is not held for trading, we use fair value through OCI. Now for our debt instruments, there are two tests to it. The first test is called the cash flow characteristics test, or what we call the SPPI test, which is called solely payment of principal and interest. That's the first test. The second test is what we call the business model test. Now these two tests drive how we classify and measure our debt instruments. Now you know this by now, that debt instruments gives the holder an entitlement to the contractual cash flows and not ownership. It is the investment in equity that gives ownership. Debt instrument is majorly concerned about the contractual cash flows, that is the inflows and outflows as a result of you entering into the contract. Now what the cash flow test does, or the SPPI test does, is that it's considered whether your transaction is in line with a basic lending arrangement. That is, the interest that you are charging as a result of you holding the asset, is it consistent with time value of money and credit risk? I mean, those simple significant elements of an interest, is it consistent with a basic lending arrangement? That's basically what the cash flow SPPI test asks. So it means that the interest that you have on the financial asset must be a consideration for the time value of money on the principal amount outstanding alone. So basically what we're looking at is that this interest that you have, is it a normal interest or not? If there is any other thing that is external to an interest or to a basic lending arrangement, then automatically your financial asset fails the SPPI test. And once it fails the SPPI test, you measure it at fair value through profit or loss. Because what it means is that what is driving that interest is something that is in the market, that is external to it. And if that thing is external to it, automatically it should be measured at fair value through profit or loss, because that means what you'll be tracking is just the fair value of it, not the contractual cash flows that relates to it. And so when you have a normal loan, sometimes they call it a plain vanilla, that is, there's nothing added to it, there's no exotic elements added to it at all. So when you have a normal loan that meets the basic lending arrangement, then you say that it passes the SPPI test. Now once it passes the SPPI test, then we'll now move it down to the business model test. But the major thing is that it must first pass the SPPI test before we can consider whether it should now be measured using amortized cost or fair value through OCI. Now, if it doesn't pass the SPPI test, automatically you measure it as fair value through profit or loss. Now, let's now say that it has passed the SPPI test because it follows a basic lending arrangement. Now, we'll move it down to a business model test. And what the business model test is, a business model is looking at the financial asset not by its characteristics, but by the way the business actually manages its financial assets. That is, the company's intention of holding those financial assets. Why are they holding the financial asset? Are they holding it to wait till the end of the period in order for it to mature? Or do they have the intention of selling those assets? I mean, how do they manage their financial assets? So the company's business model drives the classification. Now you see here that One method that actually makes more sense than the other depending on the company's business model. So if you plan to sell it, why do you need to be tracking inflows and outflows? And that's why if your plan is to sell the financial asset, you measure it at fair value through profit or loss. But if you do not plan to sell it, then it means that you have to be tracking the cash flows that relates to it. And if you be tracking the cash flow that relates to it, it is the amortized cost that does that. And that's why if you are not selling it, you are holding it to maturity, you measure it at amortized cost. But if you are planning to sell it, you measure it at fair value through profit or loss. But there are some situations whereby you are planning to hold it and also to sell it. Now, for example, in a situation whereby your company has a capital expenditure that it wants to invest in the future, and because it needs funds to be able to make that investment in the future, it decides to start making investments in some financial assets. And the intention is to sell those financial assets at the point of starting that project in the future. So what it means is that the investment that I have made in this financial asset is actually to hold it and also to sell it. So if you are holding it to sell it, then you measure it at fair value through other comprehensive income, because the point of selling it is in the future. So an example of amortized cost is when a microfinance bank gives out loans to its customers with the expectation that the customers will repay over the agreed period. Now, because you are holding to collect cash flows from the customer, you measure it at amortized cost because you have to track the inflows and outflows. You measure it at amortized cost. But the example where we talked about investing in a financial asset and selling it in order to start a project, that one is you are holding it with the intention of selling it, that you are holding it and you are selling it. That will be measured at fair value through other comprehensive income. But if you are investing in an asset and speculating to sell it at any point in time, then that will be fair value through profit or loss. So amortized cost tracks inflows and outflows, which is cash flow. Fair value through OCI says you are holding it for a period of time and then you want to sell it at a future date. But fair value through profit or loss says that you are holding it and you want to sell it at any point in time. So that is the difference between the three. Okay, so let's look at this example. It says here that company A and company B operate two different business models. Company A prefers to sell its loans to a factoring company, while company B uses its recovery team to collect outstanding balances from customers. The company's loans are debt instruments that pass the SPPI test. How should the loans be measured by company A and company B? So if you look at it, company A sells its loans to a factoring company. Now remember we said that if your plan is to be selling your financial assets, you measure it at fair value through profit or loss. And so what that means is that company A will measure it at fair value through profit or loss. But company B's intention is to use its recovery team to collect outstanding balances from customers, meaning company B is tracking inflows and outflows of cash. As a result of that, company B will be measuring at amortized cost. Now this one also says company A has an objective of managing its financial assets to collect contractual cash flows. The company is required by its regulator to frequently sell its loans to demonstrate that its assets are liquid. The value of the assets sold are significant. The company's loans are debt instruments that pass the SPPI test. How should the loans be measured by company A? Now, if you look at it, company A is expected to measure it at fair value through profit or loss. Why? Because the regulator insists that you have to frequently sell your loans. And if you are selling your loans, automatically you measure at fair value through profit or loss. Because at every point in time, you'll be looking at what the market is saying, how to realize the financial asset. So it doesn't matter, even if your business model is to hold to collect. If you have a regulator that says you actually have to be selling it, then the business model inherently has changed. And as a result, you measure the fair value through profit or loss. So can you solve this? Company A has a business model to hold its debt instruments and collect contractual cash flows till maturity by using its recovery team to collect outstanding balances from customers. One of the loans the company issues has an interest that is based on its country's share price index. How should the loan be measured by company A? So if you have enjoyed this, please give a like, comment, share, and I'll be back for more. Thank you.